Volume is one of the most honest signals the market offers, yet it is also one of the most ignored or misunderstood. Many traders focus almost entirely on price, believing that price alone contains all necessary information. Others glance at volume casually, without knowing what they are actually looking for. In reality, volume is not a secondary indicator. It is the force behind price movement. Price tells you what happened. Volume helps you understand why it happened and whether it is likely to continue or fail. At its core, volume measures participation. It answers a simple but critical question: how much effort did it take to move price? A price move with strong volume suggests conviction. A similar move with weak volume suggests hesitation. This distinction matters because markets do not move on price alone. They move on agreement. Trends persist when many participants are willing to transact at progressively higher or lower prices. Trends fail when that participation fades. One of the most important ways to use volume is to confirm trends. In a healthy uptrend, volume often expands during impulsive moves higher and contracts during pullbacks. This pattern tells you that buyers are aggressive when price advances, and sellers are less committed when price retraces. The market is accepting higher prices. In a downtrend, the opposite is usually true. Volume expands on sell-offs and contracts on bounces. When this relationship between price and volume is intact, trends tend to persist longer than most traders expect. Problems arise when price and volume begin to diverge. Divergence does not mean reversal is guaranteed, but it does signal that something is changing beneath the surface. For example, if price continues to make higher highs, but volume steadily declines, fewer participants are willing to chase those highs. Momentum may be weakening, even though price still looks strong. Conversely, if price is making lower lows, but selling volume is drying up, downside pressure may be exhausting. Volume divergence is an early warning system, not an entry signal. Volume is especially powerful at key levels, such as support resistance trend lines and Fibonacci zones. A breakout above resistance on strong volume suggests genuine acceptance of higher prices. The same breakout on weak volume is far more likely to fail, trapping late buyers. Likewise, a breakdown below support accompanied by heavy volume often signals urgency and continuation, while a breakdown on light volume may reflect temporary imbalance rather than real conviction. Reversals are where volume becomes most misunderstood. Many traders expect volume to spike exactly at the turning point. In reality, volume behavior around reversals is more nuanced. Major reversals are often preceded by climactic volume, where participation surges dramatically as emotions peak. This can mark the end of a move, not the beginning of a new one. After that, climax volume may drop sharply as price stabilizes and structure forms. The reversal itself often begins quietly, not loudly. Understanding this sequence prevents traders from chasing exhaustion instead of waiting for confirmation. Another common mistake is treating volume as an absolute number rather than a relative measure. Volume must be read in context. Is current volume higher or lower than recent average? Is it increasing or decreasing as price approaches a level? Comparing volume across time provides insight. Staring at a single bar does not. Professionals read volume comparatively, not precisely. Time frame matters here as well. Volume signals on higher time frames carry more weight because they represent participation by larger players. A volume spike on a daily chart reflects institutional involvement. A spike on a 1-minute chart may reflect noise. This does not make lower time frame volume useless, but it does change how much trust you place in it. Aligning volume signals across time frames strengthens confidence. Volume also helps distinguish breakouts from fakeouts. In choppy markets, Price often pokes above or below levels, briefly triggering stops and entries before snapping back. These fakeouts are usually accompanied by weak or inconsistent volume. Real breakouts tend to attract expanding participation as price moves away from the level. Waiting for volume confirmation can reduce false signals, even if it means entering slightly later. One of the most valuable roles of volume is psychological. It helps traders avoid emotional decisions. Instead of reacting to price movement alone, volume asks you to pause and assess commitment. Is the market truly moving with force, or is it drifting? This pause often prevents impulsive entries and premature exits. Volume slows you down in a way that improves decision quality. However, volume is not a standalone solution. It does not tell you where to enter, where to place stops, or how large to trade. Like all tools, it works best as part of a confluence-based approach, combined with structured trend analysis and risk management. When volume agrees with price, confidence improves. When it disagrees, caution is warranted. Perhaps the most important mindset shift is accepting that volume does not predict. It reveals. It reveals commitment, exhaustion, and disagreement. Traders who learn to read this language gain a deeper understanding of market behavior that price alone cannot provide. Those who ignore volume often find themselves repeatedly surprised by moves that shouldn't have happened. And once this foundation is clear, the next step is learning how to apply volume analysis in specific situations, such as breakouts, pullbacks, trend continuations, and reversal setups, and how to avoid the common traps that cause traders to misread volume entirely, which is exactly where we need to go next. By examining how volume behaves in real trading situations and how professionals use it to refine entries, manage risk, and avoid being trapped by false signals. Because volume only becomes useful when it is applied to specific contexts rather than observed in isolation. In trend continuations, volume acts as a health check. When an uptrend pulls back on declining volume and then resumes upward with renewed volume expansion, it suggests that sellers were temporary and buyers have returned with conviction. This pattern tells you that the trend is being defended, not exhausted. Entering after volume reappears in the trend direction often produces better risk control than chasing price during the initial surge. The absence of volume on pullbacks is not weakness. It is often strength. During breakouts, volume plays a filtering role. A breakout through a well-defined level is meaningful only if participation expands as price moves away from that level. Strong volume indicates acceptance of new prices and increases the likelihood of continuation. Weak volume suggests hesitation, where price may be probing rather than committing. Professionals often wait to see how volume behaves after the breakout, not just at the moment it occurs. A brief pause, followed by renewed volume, can be a higher quality signal than an immediate spike that fades quickly. In pullback entries, volume helps distinguish normal retracement from trend failure. A pullback accompanied by heavy volume against the trend suggests urgency and potential structural change. A pullback on lighter volume suggests profit-taking rather than aggressive opposition. This distinction matters because it influences both entry timing and stop placement. Volume does not tell you to buy or sell. It tells you how much resistance your idea is facing. Reversals are where discipline is most tested. True reversals rarely announce themselves with clarity. Instead, they often follow a sequence climactic volume as emotion peaks, followed by diminishing volume as price stabilizes, and only later renewed participation in the opposite direction. Traders who buy or sell into climactic volume often mistake exhaustion for confirmation. Professionals wait for structure to form and volume to return in the new direction. This patience avoids entering too early and absorbing unnecessary drawdowns. Volume also helps manage trades already in progress. If price moves in your favor, but volume dries up, momentum may be weakening, and risk management should tighten. If price moves sideways on declining volume, the market may simply be pausing. If adverse movement appears with expanding volume, risk should be respected quickly. In this way, volume informs trade management as much as it informs entry. One of the most common traps is overinterpreting every volume spike. Not all volume is meaningful. News releases, rebalancing, and mechanical flows can distort short-term volume without changing the underlying structure. This is why context matters. Volume should be interpreted relative to recent behavior, key levels, and time frame. When volume aligns with structure, it matters. When it contradicts structure without follow-through, it is often noise. Ultimately, using volume effectively requires restraint. It is not about predicting reversals or validating every move. It is about asking better questions. Is participation increasing or decreasing? Is commitment broadening or narrowing? Is price being accepted or rejected? These questions slow decision-making and reduce emotional errors. Volume does not make trades work. It helps you avoid the ones that should not be taken. In the end, volume analysis deepens your understanding of market behavior. It shifts your focus from what price looks like to what the market is doing. Traders who integrate volume thoughtfully tend to trade less, wait more, and choose better moments to act. That selectivity over time is what separates consistent execution from repeated surprise. If this continuation helped you see how volume fits into practical trading decisions, consider subscribing to stay with these long-form discussions focused on clarity over complexity, and leave a comment sharing where volume has confused you most in the past, because identifying that confusion is often the first step toward turning volume into a genuine edge rather than a background distraction.